Hello everyone. Welcome to the South Post webinar, Net Zero and Your Business, whereby we navigate the changing financial landscape. My name is Winnie, based in South Post, Singapore, whereby I take care of our business in the Asia region. I'm your host for today. Thank you for spending your time with us. We gathered today particularly to discuss some of the takeaway of the 2025 South Pole Net Zero report, and also hear our guest speakers' thoughts on the findings and share their own experiences with us. This year's report, which is named Global Financial Institutions Zero In on Net Zero, we surveyed 350 financial institutions globally and explored their progress on net zero targets, as well as what they expect from their portfolio companies. We have chosen to do this because financial institutions have the power to lead the market. Capital drives decision, and it is in the longer interest of financial institutions to make sure it's directed towards a resilient, low-carbon future. They also provide a window into the priorities of the business world as a whole, allowing us to see trends at scale. Before I go on, may I quickly share some housekeeping rules? Please mute your microphones on joining, and do so if your microphone is still on. Please feel free to submit your questions in the question box at any time. The session is being recorded and will be shared post-webinar. Okay, I myself particularly like a quote: "The cost of inaction is far more expensive than the cost of action." The cost of the climate inaction is also escalating. This is also a recurring message we hear at Ecosperity event, which happened in Singapore last week. The UN has also reported on 2024 being the hottest year on record, at 1.55 degrees Celsius above pre-industrial temperatures. Most importantly, in Asia Pacific is the most disaster-prone region in the world, with extensive coastline, low-lying territories, and many small island states. Its geography makes it highly susceptible to rising sea levels and weather extremes. So where do we stand? Now that we have passed the 1.5 degrees Celsius mark, there's no turning back. We cannot wait for pledges and targets, government policies and action to stop the temperature rise. The private sector is critical for climate actions due to its financial resources, technological innovations, and capacity to drive large-scale changes. We need urgent, comprehensive climate action, and business must help deliver it. The private sector plays a crucial role in turning ambition into action, from reducing supply chain emissions to investing in nature. Businesses have tools, know-how, and influence to initiate change. So we're counting on the financial sector, which holds the key to accelerating the net zero transition. But are we ready? Okay, we see a few faces on the camera. So introducing our guest speakers for today. We unfortunately do not have Miss Kimberly Tan, who is the head of investments, managing director at Gen Zero, with us today due to some things that have come up. But she has actually pre-recorded a video which we'll be sharing later. And then next on the screen, you'll see Mr. Kenneth Ho, head of sustainability, SeaTown Holdings, whereby SeaTown is a leading Asia-focused alternative investment firm with deep expertise across private and public sectors. And then we also have Ms. Michelle Loy, who is Principal Consultant on Sustainable Finance at South Pole, whereby she has nearly 2 decades of experience in the financial service industry, supporting on ESG and sustainable finance strategies. And I myself, I've spent almost 2 decades in the energy and commodities information space and spent a huge part of my career on energy transition fields, which then now brought me to South Pole, whereby we are a climate company supporting the industry on end-to-end climate solutions. Quickly going through the agenda for today, we'll be starting with a keynote speech from Kimberly of Gen Zero, whereby she shared her thoughts on the power and responsibility of finance. Then I'll invite Michelle from South Pole to come to share our findings on the 2025 South Pole Net Zero report. And then lastly, we'll be moving towards the fireside chat, whereby we'll have Kenneth from SeaTown Holdings to join us before we open the floor to Q&A. So this is our brief agenda for today. And if that's the case, maybe can we quickly move on to the Kimberly's video from Gen Zero, whereby she has recorded her thoughts for us. And if I can actually share the video on this, thank you.
So good afternoon, everyone. Thank you, South Pole, for the invitation to speak today. So first, I would like to acknowledge South Pole's latest Net Zero report. The insights in this year's edition are timely and important, particularly as we reflect on the role of finance in accelerating climate action globally. So we're now well into 2025, and it is clear that this year has marked a shift. Global uncertainties and inflationary pressures have led to a noticeable scaling back of climate ambition. In this context, it is understandable that many businesses face challenges in their progress towards net zero. At the same time, the effects of climate change are becoming increasingly severe. The Asia-Pacific region accounts for more than half the world's population and includes several of its fastest-growing economies. The region is also particularly exposed to climate-related risks. 2024 saw a record number of extreme weather events across this region, with economic losses estimated at $65 billion. These underscore that managing climate risk is increasingly critical for business resilience. So unsurprisingly, South Pole's report highlights that 77% of financial institutions now prefer to invest in companies with a credible climate transition plan. Now, this is a significant shift. Transition planning is no longer just a disclosure exercise. It is a concrete indicator of a company's capacity to manage risk and adapt to structural changes in the economy. So indeed, climate change is reshaping how and where economic value is created. Technology, supply chains, regulatory frameworks, and consumer preferences are all swiftly evolving to address physical and transition risks. So investors who act early to leverage these shifts will be better placed to generate sustainable returns while contributing meaningfully to climate goals. So at Gen Zero, we take a deliberate approach to capital allocation. We focus on opportunities that align financial returns with sizable climate impact. Our investments span nature-based solutions, low-carbon technologies, and carbon markets. And in developing our investment strategies, we consider both the physical risk of climate change as well as the opportunities to capture value created by an evolving transition landscape. Now, this could come in the form of technology disruption or significant policy shifts that could lead to demand for a new technology or business model. So our investments into the sustainable aviation fuels or SAF sector leverage this dynamic. So SAF is essential to decarbonizing the hard-to-abate aviation industry, but it remains fraught with evolving production pathways, uncertain cost curves, and a complex regulatory environment that varies across jurisdictions. So against this backdrop, we invested in CleanDrool. So this is a US-based startup that uses agricultural waste to produce a superior biofuel with higher energy density compared to conventional jet. So this higher energy density increases the range and fuel efficiency for airlines and reduces emissions by as much as 70%. So in other words, we believe that our investment thesis, while climate impact-led, is ultimately commercial, as we are investing into a better product that airlines will be willing to pay more for, even without accounting for its environmental attributes. So at the end of the day, it is not just about getting financial returns, it's also about setting the pace and direction of the transition, and recognizing that finance plays an active role in shaping the trajectory of the real economy. So the finance sector is especially critical for Asia's journey to net zero. Asia's economy continues to grow, driving greater demand for energy. The region also remains highly reliant on fossil fuels like coal, while investments in clean energy and energy storage and grid modernization have been inadequate. Financing support for technological and business model innovation, as well as financial innovation like blended finance mechanisms and carbon markets, will be key to support the energy transition in Asia. Thank you for listening to my thoughts on the role of finance in decarbonizing Asia. I hope you enjoy the rest of the webinar. Thank you.
Okay, thank you, Kimberly. So one said in Kimberly's video, transition planning is no longer just a disclosure exercise. It's a concrete indicator of companies' capacity to manage risk and adapt to structural changes in the economy. With that, may I pass this on to Michelle for her sharing on the insights from South Pole's Net Zero report? Michelle, please.
Thanks, Kimberly and Winnie. So, as Winnie mentioned, this year we surveyed 350 financial institutions across 13 countries to gain insights into how they are addressing climate risks, financing the transition, and also managing emerging opportunities. The findings shed light on how these institutions are reacting to both the challenges posed by climate change and also the opportunities for a sustainable future. So allow me to take the remaining minutes to walk you through the 4 global findings from the report. So the first finding that we have on page 10, really, yep. Our first finding paints a picture of a quiet and cautious progress. Despite the recent turbulent climate and economic landscape that we are seeing, 86% of surveyed financial institutions say they are either on track or partially on track to meet their net zero goals. This is a promising sign. However, when we dig deeper, only 50% have what we call extensive and credible climate transition plans. But what's slowing them down? A couple of reasons. A lack of clear regulation, inconsistent industry guidance, and also limited progress from the companies they finance. These external dependencies are acting as speed bumps for financial institutions. This also echoes one of the key insights from this year's Net Zero report, that even as financial institutions express strong ambition, action often lags, especially when frameworks are vague and climate performance data from portfolio companies is lacking. So while the direction is right, more work is needed on the pace and consistency. And on finding number 2, where we see capital is flowing to climate-conscious companies. Our second finding shows that capital is beginning to speak louder and is speaking the language of transition, as you've heard Kimberly mention earlier. 77% of the surveyed financial institutions now say companies with credible transition plans are more attractive investment targets, and 61% indicate that progress on net zero directly influence how they allocate capital. This means climate is no longer a reputational concern, but it is an investment criteria. Financial institutions are starting to favor climate-conscious companies, not just because it's the right thing to do, but because it's increasingly linked to long-term performance and risk management. More importantly, financial institutions are not only aligning internally, they are also incorporating external solutions like carbon credit strategies as part of broader capital flows. This signals a shift that climate action has become a core filter for financial decisions and not just an afterthought or a side initiative. As we move along to see finding 3, we do note that engagement is on the rise. This is another focus in strategy, where we see 88% of financial institutions intend to deepen engagement with their portfolio companies or clients to drive decarbonization rather than to divest. This reflects a strategic change, transforming high-emitting sectors from the inside out, instead of walking away. Further, we see 44% say that their top decarbonization priority is increasing exposure to green assets and companies with transition plans. This dual approach, engage where change is possible and also invest where change is already happening. It reflects a maturing understanding of the role finance can play in accelerating real economy transition. And last but not least, our final global finding, in terms of looking at having more communication, but more conservatively. This touches on how financial institutions are evolving in their climate communications. Over half, 53%, are increasing their net zero communications, showing a greater willingness to engage publicly on climate. However, at the same time, we see 27% are choosing to make more conservative claims. This could be a direct response to rising regulatory scrutiny and also the threat of greenwashing accusations that we see. Institutions are walking a fine line. They want to demonstrate leadership, but they also need to ensure that what they say aligns with what they do. It's a signal that we see transparency and credibility are becoming non-negotiable as expectations from regulators, clients, and the public grow. And I'm sure everyone's excited to think about what's happening in Asia Pacific. That's the global lens that we had, but we also want to bring you back to Asia Pacific to see where and what are some of the financial institutions thinking about. And as we turn the focus to Asia Pacific, we do see similar themes on climate transition plans. They are growing, but outpacing also global average. In Asia Pacific, we do see a mixed picture. Some markets are leading on transition planning, while others are approaching with more caution. So in Singapore, we see 83% of financial institutions standing out. Nearly all of them report having a climate transition plan. Most of these financial institutions based in Singapore says that it directly influences their investment decision. And it shows a strong alignment between corporate action and also capital priorities. On that, in a contrast, Japan shows a more conservative approach to engagement. While we do note that 74% of financial institutions are increasing their efforts, with portfolio companies, only 1 in 10 are significantly ramping this engagement up, which is well below the global average of 44%. Now, what do all these differences tell us? They tell us that while momentum is building in APAC, strategies and expectations still vary. And for businesses, what this means is understanding your investor landscape. It's really key, especially when you're looking to raise capital or to expand in the region. Back to you, Winnie.
Thank you, Michelle. Sorry, was a bit of clicking to get the tag back. Okay, with that, may I now invite Kenneth, the Head of Sustainability, SeaTown Holdings, to join Michelle and myself for the fireside chat. Okay, thank you for coming on, Kenneth. Okay, so if I may just share a little bit about Kenneth to help us set a little bit of context to our fireside chat. So Kenneth, who is the Head of Sustainability for SeaTown Holdings, founded and headquartered in Singapore since 2009. SeaTown is actually a leading Asia-focused alternative investment firm with deep expertise across private and public markets. And owned by Suvara, Temasek Asset Management Group, SeaTown is the trusted steward of capital, investing alongside its investor in conviction-driven strategies. And SeaTown is also a member of IFRS Sustainability Alliance, a supporter of TCFD, a signatory of UN Principles for Responsible Investment, and a member of Asia Investor Group on Climate Change. Wow, with such a deeply rooted beliefs in integration of climate plans and action into your investment strategies, we'll certainly love to hear your views, Kenneth.
Thank you very much, Winnie, and thank you very much for the invite. Very pleased to be here with you today.
Yeah, sure. Kenneth, so perhaps let's dive right into the topic, because I do notice that we are maybe running a little bit short of time. So we are particularly interested in how SeaTown integrates climate risk into your investment decision, because being such a key investor in the region. So maybe can you share how this nuanced region-specific approach helps you manage both physical and transition risk across portfolio?
Certainly. So I think I just also want to reflect and connect the dots for the audience to what has been shared earlier by both Kimberly as well as Michelle. By and large, for us, we definitely consider climate risk to be financial risk. And that's why we integrate it into our investment decision making. And I think that's also reflected in the statistics shared in the report that, in Asia, anywhere from high 70 to 80% of investors do incorporate this into financial decision making. I would also add one more lens, which is that by and large, in many regions of the world, many regulators do encourage financial institutions via either regulation or guidelines to consider, environmental risk and climate risk as financial risk. So turning to SeaTown's approach, first and foremost, we look at it from two angles, right? For every investment that we make, be it on the public side or the private side, firstly, of course, is the transition risk, and secondly, is the physical risk. In my role as head of sustainability, I also run what we call sustainability research and advisory for all our investment teams. And we take a three-step approach to incorporating this. Number one, my team actually does what we call investment research on macro ESG issues. And the way we define macro ESG issues are, ESG issues, be it environmental, social, or governance issues that impact every asset class, every region, and every geography, right? So things that would qualify as macro ESG risks would be things like climate, clearly, but also issues such as cybersecurity. That's another one that has very, very broad-based impact. So step one is really conducting that kind of investment research to make sure that the investment teams are aware of the evolving nature of this risk, and also side by side with that, the evolving policy risk in many regions for these type of issues as well. Secondly, the step two is that my team also curates many proprietary tools for all our investment teams to use so that they can run a first-cut diagnostic or diagnosis on every investment that comes by. And these tools empower them and enable them to assess the risks and make sure that they mitigate the appropriate risks. And it's not one-dimensional. It's not only about risk. There are also opportunities, right? And so the investment teams also consider that. Now, finally, there might be circumstances where the investment teams feel that they need additional support, right? And my team stands by to provide what we call advisory support and capability anywhere across the investment process to further and empower the team to help them generate durable returns. Now, the bottom line of all of this is that it's anchored and rooted in financial materiality, because by and large, that is the primary role of an investment manager and an asset manager. Oh, thank you.
Thank you, Kenneth. That was very, in-depth work that you guys are doing at SeaTown. So that brings us to maybe a question for Michelle. So how are you seeing climate risk integration evolve among clients, both businesses and financial institutions, especially those in Asia, since we are all seated in Asia, whereby regulatory framework may just be catching up? And how does this impact business attractiveness to investors and banks?
Thanks, Kenneth, for the insight, and Winnie for the question. So after almost, I'll say 20 years advising asset owners, asset managers, and banks in Asia Pacific, I've seen the climate risk conversation shift from a why to a how. Essentially, climate risk integration is very fast evolving, as you've mentioned, Winnie. It's also become a very crucial aspect in many businesses and financial institutions, business and financial decision making, right? It's not just within the financial institution space, but across all industries and sectors. In Asia Pacific, we do see a ramping up of climate reporting or sustainability reporting. In the second half of just 2024 last year alone, we do see about 21 new sustainable finance policies across taxonomies, disclosure mandates, reporting requirements that were rolled out in the region. However, we are seeing more clients embed climate risk, not to tick regulatory boxes, but to price risk, to capture opportunities, as Kenneth mentioned, but also to build resilience, beyond thinking about mitigation, but adaptation too as well, and the survivability of the business. Increasingly, we also see capital flowing to businesses that don't just report on risk, but demonstrate how climate risk is shaping their governance, how it's shaping their capital allocation, and also how they're innovating as a business to make sure they stay relevant in changing times and the turbulent economic landscape that we are seeing. As we've mentioned earlier, our net zero report notes that 77% of investors do view companies with credible transition plans as the most compelling investment opportunities, since financial attractiveness follows clear and actionable climate strategies. So I would say this shift really matters, with Asia, really facing up to a large GDP loss under severe warming. Climate risk integration is really a business imperative that shapes access to capital, but also the long-term viability of business.
Thank you, Michelle, for the insights on this. So this actually brings us back to what SeaTown is doing. So as what Kenneth described just now, whereby you highlighted a partner mindset when engaging with portfolio companies. Maybe Kenneth, can you walk us through a practical example of how SeaTown has helped a company close ESG or climate-related gaps through your stewardship efforts?
Great. So maybe just taking a step back, for SeaTown, investment stewardship is a very, very important tool for us to help generate durable returns and also to help our end clients achieve the outcome that they want. And in most instances, that is primarily financial return. In some instances, they might want even more, right? And so investment stewardship is a very important tool. We apply that across all the asset classes that we manage, be it in the public space or private credit or private equity. But maybe in the example that I'll talk more about today, I will use private equity example as a way to illustrate how we work with the portfolio company, right? So I think very similarly, it is also a three-step process. Linking this back to the sustainable research and advisory capability that I mentioned. I mentioned that the team does investment research related work on a lot of macro ESG topics. We actually take some of these work and use that to engage the private equity portfolio companies that we work with. So step one is to really create awareness and also demonstrate that we have the capability to help the portfolio company identify the gaps and also close the gaps, right? And then number two, it's illustrating the why, right? Why is it financially material for the portfolio company to want to close this gap? For example, it could be pending regulation, it could be a pending carbon price policy, all right, or data security or data privacy policies in the jurisdiction that now means that you either have to pay a price or pay a fine if some of these get breached. And then thirdly, we position ourselves as a solution provider to the company as well. So in private equity, generally speaking, there is a portfolio development team, a team of consultants that work with portfolio companies across a number of issues. My team will work together with this team to interface with these private equity portfolio companies, go in there and develop the solutions, help them curate vendors, and help them close these gaps. So that's the way that we work together with our portfolio company.
Thanks for sharing that, Kenneth. So as I hear, right, engagement is often cited as key to advancing net zero. Yet many APAC-based financial institutions lag behind global peers. Michelle, perhaps what are your recommendations for clients looking to shift from passive disclosure to active engagement strategies?
Thanks, Winnie, for the question. So I would say many start with data. That's crucial for sure. But the real impact really comes from meaningful dialogue. Some of the steps that Kenneth has alluded to also as well. If I think about the region itself, obviously it's still very heavy in terms of fossil fuel. And many financial institutions are still choosing to engage with their fossil fuel portfolio companies. But the concept behind here is really to support transition rather than simply exiting the positions, which is a team of engagement and stewardship, which Kenneth has alluded to earlier, and the question that you're asking as well. And in Asia Pacific, especially in Singapore, we do see a lot of financial institutions collaborating very closely with companies to align with business models and net zero goals also as well. In the industry, we do see a lot of industry association as well that are pushing portfolio engagement on climate targets. It can be a net zero asset owner alliance, the principles for responsible investment. Within the Asia region, there's also the Asian Investor Group on Climate Change that has been helping investors to initiate structured engagement on decarbonisation. So for example, there are ongoing dialogues with utilities and banks in the Southeast Asia region to push for science-based transition plans and decarbonisation. So really, engagement, it's about collaboration. It's a communication, it's a two-way street. It really is a lever for shaping real world outcomes. So to your question, Winnie, my recommendation would be really starting with materiality. Kenneth alluded to this earlier too as well. To think about where your investment or financing related emissions are concentrated. Then define the targets and the clear actions that are tied to sectorial decarbonisation pathways, but also to think about materiality in terms of the climate and nature related risks to your portfolios. And coming back to the theme of engagement, the second bit I would recommend is to think about localizing some of these engagement strategies in Asia, where relationships matter deeply and engagement practices are still maturing. We do need to factor in some of these local nuances also as well. And lastly, I would say aligning your engagement strategy with your internal lending and or investment policies. That's really important to ensure that there's consistency and credibility, and that builds trust also as well.
Thank you, Michelle. I think interesting point that you mentioned about localizing to suit local nuances. That brings us nicely into my next set of questions, whereby we talk about policy signals in the region and the power of clear regulation. So maybe Kenneth, if you can share with us, you highlighted the importance of consistent and clear policy signals like Singapore carbon tax trajectory. How does regulation, when done well in your opinion, help shape investment decisions and encourage long-term planning?
Thank you, Winnie. I think taking a step back, a lot of the issues that we talk about from an environmental or social ESG kind of perspective is really about externalities that businesses generate, and how do we tackle some of these issues and challenges. And generally, I think there are two vectors that can help close these gaps. Vector number one is technological improvement and natural cost improvements that will make businesses naturally adopt a number of these solutions. That doesn't exist in every case, or in some areas, the technology is still too early. And then the second vector comes into play. And that second vector is effective, clear, and consistent regulation. So taking the example that you mentioned about carbon price or carbon taxes, I would say today across the world, roughly about a quarter of the emissions in the world carry a carbon price or carbon tax, primarily in the compliance markets. And in many of these jurisdictions where that carbon price is consistent, coherent, and when there's visibility that it's going to continue or going to go up, it has been our experience when we engage with portfolio companies that this really, really helps them make their financial decisions, because they can incorporate this carbon price, not just for this year or backward looking, but they're able to incorporate it on a forward looking basis. And that really, really helps them make either OPEX or CAPEX decisions, because they can then internalize that cost and balance between a traditional alternative as well as a newer green alternative.
And an interesting point on the internal carbon pricing within corporates itself. So in that case, Michelle, maybe can you share with us a little bit, especially, when we talk about, internal carbon pricing and whatnot, how can businesses use regulatory developments as a strategic lever, not just as a compliance requirement in their net zero transformation plans?
Thanks, Winnie. I would say companies and financial institutions alike, they used to think regulation as a hurdle. Maybe some still do. Today, that mindset is gradually changing from a constraint to very much a catalyst. So I mean by that, for example, regulatory pressure to disclose under ISSB, that's really fast moving in our region, is prompting a lot of companies to finally build the internal systems that they've postponed for years. It's become the impetus. And also taking the deeper look, for example, into their enterprise risk management systems, right? Everything has to be connected. So regulations do drive transparency and opportunities. Early adopters use them to trigger strategic conversations also as well around value chain resilience, climate risk scenario planning, and also access to sustainable finance. So I would say don't just react to the regulations, again, not as a tick box, but really reframing that mindset, both internal and the way you communicate also as well. There's a real opportunity to leverage regulations to build a competitive edge, to differentiate, to also help you unlock capital and shape your impact story.
Thanks for bringing up this point, Michelle, about this not being just a tick box exercise, but rather more about mobilizing capital for net zero opportunities. So, Kenneth, we've seen significant investment into low carbon technologies driven by improving economics and rising demand. What current opportunities do you find most compelling, and how are you preparing for what's next?
I also want to link the conversation to the previous point we talked about. So I talked about two vectors, right? Number one is technological improvement, and the second one being effective regulation. I would say in the realm of improving technology and continuing cost improvements, we actually use this framework called the Green Premium Framework. So this was popularized by Bill Gates. And what it is effectively, it compares the green alternative to the traditional alternative. And if it costs more, the green alternative costs more, that's a premium. And because of technological improvements, there are actually quite a number of technologies and areas where the green premium is now negative. And what that means is actually more cost effective to adopt the green solution. And in these areas, what you will find is that a lot of businesses, even if they do not frame the conversation as an environmental initiative, they would do it anyway, right? So these would be areas like resource efficiency, not just energy, but resource efficiency overall, where the company saves money, but it's also good for the environment. And then secondly, I think in a whole bunch of other areas, such as renewables, such as batteries, such as grid infrastructure, in a lot of these areas, the green premiums are now low or negative, right? So in renewables, for example, the cost have fallen by about 70% over the last 10 years. In batteries, about 85%. And in grid infrastructure, many of the grids across the world are aging and aging significantly. Over 75% of the grid infrastructure in the world is older than 10 years old. And that is against a backdrop where electricity demand is increasing because of electrification, as well as data centers. So in that world, the demand growth profile of electricity needs in the world has been about 2% over the last few years. And because of electrification, as well as data centers demand, that profile now steps up to about 4% plus. Right? So these are all areas that we see as reasonably compelling areas for investment in many of these low carbon areas.
Thank you, Kenneth. So on the point about green premiums coming down, so Michelle, perhaps if you can maybe speak about how at South Pole, we are seeing companies in APAC wanting to attract capital for green growth, and where should they focus to signal ambition and build confidence in their investors?
Thanks, Winnie. I'll say again, the way I look at it, maybe because I've always been like a risk and opportunity kind of person, I always think that it's an opportunity for change, right? What's going on in the market right now? It's an opportunity for change. And really, it's a shift, both mindset and the way you are operating as a business, moving to a more agile and innovative model, rethinking about how you deliver value, how you engage your clients, how you operate your business. I would say ambition without action won't move capital. To your very much earlier point, Winnie, the cost of inaction is much more than action. And investors want proof, not promises, right? So to attract capital, I would say, obviously, the development of a credible transition plan, as you've heard a lot in this conversation today and in our findings, it's also one key area to think about. Also reflecting last week in Ecosperity, what we hear investors and banks talk about, and one also as well, is the topic on climate transition plans. Thinking about transition financing in the region, which is very prevalent for us, very relevant. Just the nature of the region itself and what we will be faced with on a climate basis. On the physical risk side, I would say a couple of things to think about when you think about your climate transition plan to add credibility to it. If you're thinking about structuring one or working with your portfolio companies and clients to develop one, I'll say there are mainly 5 areas that we look at. One, obviously, very first and foremost, it must be aligned with science. It must be aligned with the Paris Agreement 1.5 degrees goal. It should cover all your 3 scopes, 1, 2, and 3 emission. It must be an integral part and fabric of your business in terms of how decarbonization affects your broader business model and strategy. It must obviously be backed by financial resources, how you are allocating financial and human resources across your organization. How are you investing money in CapEx, your capital expenditure, your OpEx, R&D, and also other non-financial resources. You should be relying on very reliable quantitative data on things on impacts, on risks, and also on your decarbonization strategy. And last and foremost, it's not a document that you set up and you shelve it away after a while. It must be a dynamic living document that you're constantly monitoring to ensure that you've got clear governance to oversee the progress. You are putting in regularly monitoring your milestones also as well. So I would say that will be one key aspect, but also thinking about the storytelling aspect of it. Don't underestimate the power of being able to articulate how your strategy and efforts support the work that you do in your community and also enabling the transition to a low carbon economy. So that clear narrative will help you build that investor confidence. It tells the market that you are committed to your action. So I'll say go build a credible transition plan. Think about that. Set clear and ambitious milestones, and also ready then the whole organization to work collectively. As a sustainability team or financing team or investment research team, it's not sufficient. You need to get the whole of organization working collectively to drive collective impact.
Thanks, Michelle. So that sort of brings us to the last question, which I would like to save it for Kenneth. So Kenneth, as a last question, how has the role of an asset manager evolved in today's fast evolving environment?
Great. Thank you, Winnie. Michelle brought up the point about Ecosperity last week. And in Ecosperity last week, it was a very large gathering of all the people in the space. And I just want to borrow a line from a very, very senior, policy maker, which I think is quite important. I think he mentioned that Singapore is neither a climate zealot or climate skeptic. Singapore is a climate realist, right? And I think I want to borrow that line because it very much reflects the way SeaTown as an organization thinks about and deals with this issue as well. Which is at the end of the day, despite a lot of changes in the world, from a political perspective about these issues, we remain as steadfast as we have been as over the last few years, because the anchoring for us really is about financial materiality. I would say one thing that we have gotten clearer on as a result of this is really speaking more the distinction between our role as an asset manager as well as a corporation. And let me dive into that a bit more. So an asset manager, at the end of the day, the role is to deploy capital to help the client meet its end objectives. By and large, for most clients, that is financial materiality. And in those areas, as we talked about earlier, we consider the financial risk, be it transition risk or physical risk. We have to mitigate that, and we tap on the opportunities where available. Now, there might be a certain group of clients that might want even more than that, and we have the capabilities to help them customize and help them achieve those outcomes. Then we come to our role as a corporate citizen, right? So in our role as a corporate citizen, this is where we take absolute responsibility for our carbon footprint, where we measure the footprint and we purchase high quality offsets from the quality organizations on this call, including Gen Zero and South Pole. And that's how we deal with it, as steadfast as we have been over the last few years. Thank you.
For sharing your thoughts, Kenneth and Michelle. So with that, that brings us to the end of the fireside chat. But do not leave us yet. We are still up for our Q&A, although we are running a little bit short, but we are happy to take maybe a couple of questions over here. So we do see, a few questions coming through, but we have to select just a couple. Maybe a question for you, Kenneth. So do you think carbon credits will still have a role to play now that we have passed 1.5 degrees?
Yes, I think while everyone continues down the mitigation pathway, there will always still remain a certain amount of residual emissions. And I think high quality carbon credits definitely still do play a role as well.
So that brings us to a very hotly discussed topic in the markets, always about building high integrity carbon projects. So I don't think we have time for questions, but we'll be happy to share more. If you could send your questions maybe to us at South Pole, and we'll get the questions answered by our panelists. So, thank you very much for your time today, everybody, especially to our panelists as well. Sorry, okay, so just maybe as a last statement, so thank you for being with us today. This webinar is brought to you by the South Pole team, whereby we pride ourselves in bringing climate impact for all. And South Pole is a climate company headquartered in Zurich, with operations in over 30 locations around the world. On top of climate advisory, we have a wide selection of climate action projects all around the world, helping governments and corporates to reach their net zero ambition. So with that, thank you very much for your time for today. And thank you to our panelists as well. Thank you and have a good afternoon.
Thank you.
Take care.